We were started on a discussion yesterday on last call about what may have driven the move in the Russell relative to the Nasdaq last week. The Russell outperformed the Nasdaq by 5%, which is actually a fairly unique occurrence. In the past decade, the prior three times that have happened were the week the Pfizer vaccine was announced in November 2020, the week the Federal Reserve announced easing in April 2020, and the week of the presidential election in November 2016. Further to this point, the Russell 2000 posted its fifth best day ever versus the Russell 1000, the other instances being October 1987, October 2008, October 2011, and March 2020. The point is, as traders search their memory for the importance of these dates or look back to the charts themselves, they're going to find a clear conclusion. The type of rotation and price action doesn't arrive at the end of bull markets. In fact, it's more consistent with a significant low being formed in equities. So before we even get to the what caused this rotation, let's just start there. Do you guys find it ridiculous to think that this is a market that still is in the early throes of a bull market, as these data would indicate?
In the early throes of a bull market, and you're suggesting that because of the times in the past when the Russell outperformed was the early throes of a bull market. That's the logic here, right?
The logic is that this is not the end of the bull market. Middle innings, early innings, it's not something that happens at the end is the ultimate conclusion.
It's not something that has happened at the end in past markets, yes. I also don't think that I don't think in any of those situations that you just described, what led up to the Russell outperforming was not a extended period of underperformance prior. So in other words, what that means is that in all those cases that you just listed as examples, the Russell was trading with a fairly normal relationship to the other indices prior to the Russell exploding. In this case, this is very different. In this case, this has been a market that has been, for the last 15 years and more so the last 5 years, dominated by the Nasdaq and then followed by the S&Ps, with the Russell and the Dow being the laggards. That situation never happened in the past the way it's happened this time. I don't think it's the same thing. I think this is sector rotation out of the beginning of a sector rotation out of Nasdaq into small caps that will probably last through a pretty significant market sell-off, which I think is coming. So actually, I do think this time, if you're asking, is this time different? My answer is yes, it is. I do not think this is the start of a new bull market as being presented by the Russell breaking out finally after underperforming for, literally for 5 years.
Well, it may not be the start of a bull market, but historically speaking, bull markets tend to run longer than what we've seen. The current bull market through last Wednesday was running for a 57.5% gain over 637 trading days. The average bull market going back to the Great Depression produces a return of 114.4% over 1,011 trading days. The median bull market produces a return of 76.7% over 522 trading days. So you think about that, we talk about going too far too fast. We're actually underperforming the median over a longer period of time right now.
It depends It depends how you define bull market. You're only using
the low in October 22.
Right. And I think that there's a lot of people that would probably say that, listen, that's the whole thing. That's why I hate historical crap, because it never, because there's so...
There it is. I was waiting for it. He had been holding back. Go ahead. Keep going.
There's so many different ways to look at it. That's why it's challenging for me as a trader, because I can easily make the argument that this bull market started in 2016, or something else. I'm not going to give this one to you. I think this one it's a little bit of curve fitting here. I think I've been trading this pair for the last 2 years. So this is not something that I'm looking at for the first time and saying, hey, you know what? This has been something that to me has been out of whack at a level that I don't think it can correct in 5 trading days and in 50 trading days. I think it's going to be 6 months to a year where the Russell's going to outperform. That's why I told Tony, I'm not touching my position, till the cows come home, because I'm not taking this Russell Nasdaq, this Russell S&P position off. I think it's got a long way to go.
It could. And actually, that's where history would serve you well, because during those periods where the Russell had that significant outperformance versus the Nasdaq, it typically continued to do so for the next few months. But let's talk about what drove that move last week, because I think the answer is somewhere in between our two positions from what we were talking about yesterday on last call. It is, I think, in part short covering still. But if we look to the flows last week in the ETF space, the Russell 2000 saw its largest inflows since December, and the XLK, the tech sector ETF, saw its second largest outflows of the year. So you talk about rotation, people selling down tech stocks, buying up Russell. It wasn't just people covering per se. People were actually buying those small caps. But according to the hedge fund flow data gathered by Goldman Sachs trading desk through last week, U.S. fundamental long-short asset-weighted exposure declined by 1.2% week over week through Friday. We think about the long-short asset-weighted exposure, it's only in the 7th percentile over the past year and the 37th percentile over the past 5 years. From the start of June, these are down from the 24th and 53rd percentiles, respectively. So people are cutting their longs. The most fascinating point that makes me think this was people selling their tech stocks, getting out of their shorts, and then buying the small caps back is the fact that we see that the Nasdaq positioning in the futures market really hasn't changed. It went from the 40th percentile down to the 39th percentile. This is below the 5-year average. That's to say that people aren't buying the Nasdaq broadly. They're buying all of the individual names, which we know people are piling into the Meta and the NVIDIA, right?
I agree with that. So, I agree with you 100%.
So that's why, having done a little bit more digging yesterday, I think we're actually both right here. There was some short covering, but the flows into the Russell by the end of last week, the best all of 2024 and the best since December 23.
Agreed. That was easy to see. And I also think that, the retail investor has actually they're really smart now. If you've been long these tech stocks, you have a lot more optionality and flexibility than institutional investors have. The institutional investors, Chris, they're kind of trapped. They can't get out of tech stocks and necessarily buy small caps unless they get into like an index, an ETF. And even that is challenging for them. On the retail side, retail investors can sell their NVIDIA and buy, do anything they want with it on the small cap side. So they have a lot more, they have a lot more options. They have a lot more flexibility with their portfolio. And I think they're also smarter. They recognize, hey, you know what? It's time to take some profits here.
You give them a lot of, a lot of liberty there with, now you call them smart too.
I think retail is always smarter than institutional. I think the institutional is dumbest investors ever, but they're also trapped by size. Like Vanetta talked about this morning, BlackRock's managing $10 trillion. Where are you going to put $10 trillion? Where are you going to put $10 trillion? Like there's only so many there's only so many underlyings that are even tradable. And so I just feel like this is a tough situation right now because institutional money managers, portfolio managers don't have a lot of flexibility unless you're doing massive sector rotation.
I know it's going to be a double negative, but they can't not be in the market. There's no place else that's giving the type of returns that they need to their peers. It's almost like feeding on itself. Now, to Chris's point about a little bit of a rotation here, I think you can see that pretty clearly.
I'm not arguing. I'm agreeing. But
my only question is, when does the Dow do it, Chris?
No. I think this is exactly what's happening. The Dow's doing it also right now. The difference is that I do not think that this is the beginning of a bull market. I think the reason for this rotation this time is different. And the reason for the rotation is because people are moving out of tech stocks because they've made enough money and they're into small caps because they think it's cheap relative and they are staying long. But it's not the beginning of a bull market.
Well, then perhaps that was the improper phrasing. It's the conclusion that I arrive at from looking at all these data is when we think about I know you don't like the historical market or the seasonality, but we wrap up that 2-week run officially July 17th is when the market tends to peak. So we think about where we are right now. We think about that maybe there's a pause here in the second half of July after going too far too fast. We're getting a little frothy thinking about how far we are removed from some short-term momentum indicators, at least from a technical perspective. This is not necessarily a market that you want to give up on. If there are buy the dip opportunities and volatility is staying relatively low, the playbook that has worked for the past several months continues to work. If anything, this tells me that we still have more room to the upside, that this is not a data series that's presenting the conclusion. We see these occurrences when the market typically tops. So sticking with what's worked, I think it's difficult, but it's been the easiest thing to do in hindsight. And so that's what I'm going to continue doing for the foreseeable future. The Russell, though, may be a big runner, though, against the Nasdaq moving forward, if history has any gauge, but you don't care about that.
If we ever get back to even, then we can talk about it.
As we wrap up the show, one of the things that's been more popular here is when I throw out a quote or two for you guys to respond to and explain your thinking behind it. Because I like to go over famous investing quotes every now and again, just for myself. One of my
famous investing quotes. Okay, who are you going to quote? Who are you quoting?
Well, no, this is like going through books like Market Wizards, for example, by Jack Schwager. And so like one of the quotes that stuck out to me a few years ago was do more of what works and less of what doesn't, which is what provoked me into segregating all of my trades into various time frames, various products, how long I held them for, different risk parameters, just to basically see what I was doing correctly. And I learned that I was a terrible scalper. Like it was producing no positive returns for me. And so I stopped scalping and my trading results started to get better over time. And so, one of the things that new traders have trouble getting their head around is that they can be right without, or rather they can make money without being right. Peter Lynch has said, quote, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10, unquote. So I suppose we could use this ending of let me explain for you guys to explain to the crowd. How did you guys develop early on in your career the ability to not take losses personally and be okay with being more wrong than you were right? Almost like a baseball player who only hits 300 and yet can still go to the All-Star game.
It's not the same. First of all, baseball player that hits 300 or 350, sure, Hall of Fame possible. The trader, especially floor traders, we had to hit way higher than that. You
hit 300, you're a loser.
You hit 300, you're out of business. Peter Lynch's quote does not his quote applies to money managers and things like that. As floor traders and growing up in this business as floor traders, we had to be right. I'm going to just say 85% of the time. And we were like, you had to survive 80. Would you say 80?
Yeah.
I'd say higher.
And maybe higher. A lot, you get a lot of scratch trades in there too. So
I would say 80 to 85% of the time you're right, but you're not right directly.
That's why it's so amazing to watch him trade now as a retail investor being wrong.
Directionally, you're not right much over 50% of the time, but you're right just because you had whatever edge. That's the difference, Chris. It wasn't the Peter Lynch quote, and I don't know who you quoted out of the market. Who was that quote from the Market Wizards book?
Steve Clark.
I'm not sure who that is. Well, a lot of those guys were floor traders with us in the Market Wizards book. That's why I bring it up, because a lot of them are friends. It's a little different, when you're like a casino won't stay in business if they're right less than 50% of the time or whatever it is. I think as a retail investor, I have learned that my percentage of winners is going to be much lower than it was as a floor trader. And that was kind of the genesis behind all the technology we've built and behind building Tasty, was that we tried to recreate an environment where we were going to be right 75% of the time, or 70% of the time, or 80% of the time, or 67%. We couldn't tell you how much money you could make by doing that. So that was kind of the whole genesis behind Tasty was, listen, we loved being right all the time as floor traders, but we had edge. How do we be right all the time as retail investors? And the answer was, we have to do this probabilistically and create enough occurrences so the numbers just play out, because that's all it is to us as a numbers game. And in order to do that, that's great. But then you have to deal with something that we never had to deal with as floor traders, which is your losses are going to be greater than your winners, because that's why you get a 70%. If you win 2/3 of the time and you lose 1/3 of the time, then your losses are going to be 2/3 bigger than your wins when that happens. It's just how the math plays out. So it's how do you address that, and how do you keep that going? And that's been the biggest challenge for us, and it still is. Like, we created the methodology to give you more wins than losses, but there's no way we can ever change the math to say that those losses aren't going to be bigger than the wins. So we have to teach people how to manage positions, how to address that kind of stuff, and that's where we're challenged. I think that's kind of what Tasty is all about, isn't it?